Let's get some insights in the news shaping the markets. It's Fed Day. And so we bring in a specialist on this day, and that is William Lee, chief economist at the Milken Institute. Good to see you, Bill Lee. Thank you for being here. What are you watching for?
Thanks for having me. Today is really a special day for the Fed because they really are sitting at that inflection point. They know that they've committed and told the markets that we're on our way down with gradually adjusting rates to go down with inflation. But then all of a sudden, the data on inflation got stuck. We've been, in fact, having rising service sector inflation, even excluding housing, since the summer. And so the Fed, with all the strong economic news about GDP and consumers, they're really having to decide, what are we going to do next year? And I think that's going to be the subject of debate right at the table.
The frustration I have is like everybody says, oh, we're going to take a look at the language, we're going to look at the dot plot. And I really just want more clarity now. I feel like I know I'm getting a cut today, right? Because we know the Fed Fund Futures says so. And then what? And then what? I mean, I'm tired of getting pulled along on a string. People are saying, look, they're supposed to cut 3 times next year, hogwash. What is it already? What is it, Billy? What are they going to tell us? What's the real deal? Will they pause? Is this the end of the rate cutting cycle?
Absolutely not. In fact, I'm absolutely convinced that they really have to continue to cut short-term rates. And let's not forget, the Fed only controls the very short end of the market. What we are really seeing concerns are the longer end. The fact that the 10-year is starting to creep back up. And why is that? It's because we have fears that inflation is really not going to be going down to 2% at the same pace we thought earlier. As I said, service sector inflation is still stuck and starting to trend up, even excluding housing. But the Fed says the banks are having a hard time. Small businesses are having a hard time because those bank loans are coming at a very high rate because the Fed funds rate is very high. So in order to help small businesses and to really adjust and get rid of the distortions that are in the capital market right now, they're lowering the short-term rates. As they say all the time, we don't control the long end of the market. The long end is controlled by long-term economic forces like growth. And so the market's going to have to adjust to the fact that the markets will set the long rate, and their anxieties are showing up in higher long rates. But the Fed, in order to help banks do their business of borrowing short and lending long, right, they have to be able to lower the cost of funds at that short end for them to make loans to small businesses and companies that are more dependent on debt financing. For companies like NVIDIA and all of these nifty stocks that are doing so well in the equity markets, they are very equity dependent, equity market financing. And so what we see is this kind of technical adjustment and recalibration, as Chair Powell's been saying, of where the markets are. Long end is going up, short end is still continuing to go down.
Okay. Look, at least that's some clarity. I wish, Jay Powell spoke as succinctly as you do. That being said, so they have to cut in order to ease the pain of the banks, the small businesses, the debt financing businesses. When do those, so probably 3 cuts in the new year, when do those come?
I think we're going to have to see something of a 3 handle on that short-term rate, because if inflation does stick around at roughly the 2.5% area, and productivity is able to keep the real rate somewhere in the neighborhood of 0.75% to 1.5%, then something of a 3 handle is appropriate at that short end. And the hope and the prayer that the Fed has for sustaining lower rates in general is that productivity really continues to grow as quickly as it has been for the last year. What we can't figure out right now, and every economist scratching their head, is this a level jump in productivity that we've seen? It's going to stay where it is, or is it a higher growth rate in productivity that is going to be brought about by AI and some of the new technologies we're seeing? If it's a higher growth rate in productivity, that is the nirvana that everyone's looking for, because that'll lead to higher wages and lower inflation. And right now, the jury's out, and the Fed is having to decide where things are, and that is the data dependency that they are really pursuing right now. Is productivity growth higher, or do we just get boosted by a level jump?
Look, I talked about what I wanted to talk about. You're an esteemed economist. I wanted to really get some clarity. Thank you for that. What do you want to talk about? What's on your mind now?
I want to caution everyone that the bond vigilantes have really not shown their hand yet. The long-term rate hasn't gone up as much as I think it will be going up because the debt financing that we're going to be seeing ahead of us, the more stimulative fiscal policy we're seeing ahead of us, the deflation that's being brought about by the Chinese and the rest of the world exporting deflation, that's going to help us with any kind of tariff policy. So I have no fear that on the good side we're going to have pretty steady inflation. But on the services side, will service sector inflation start to come back down? Will your cost of auto repairs, medical services, education services, getting a haircut, will those services continue to rise at a 3.5% pace, which is roughly where they've been doing since the summer and since last year? That has been stubbornly high, and until we see progress there, the likelihood of a fast pace of Fed rate cuts is out the window.
Yeah. You know, sometimes it's fun to just have hindsight, which is 2020. Was there a big miss? Was there, I mean, it's okay, you can say it. Was there some sort of big miss along the way on any part, whether it was the Fed or anyone else, any decision making? Was there a big miss moment?
Guilty. Absolutely guilty. I came on your show back then and said, I think this inflation is going to be transitory. I and everyone else. But we were all thinking about these supply chains coming back online. And again, those are goods prices that we're talking about. The real miss that we might have now and not appreciate is how sticky the service sector inflation is. And that's not supply chain related. That has to do with immigration policy, the number of people out there providing us those restaurant services, haircut services, and pet care services, the travel insurance, or rather car insurance. These are the services that I am fearing are going to keep the inflation rate up. And we're not going to see the productivity growth in those sectors to bring down those prices. And as much as AI and new technologies are coming in place, getting a haircut is still getting a haircut. You still need someone to cut your hair. And I'm not going to let a machine come down on my head and start chopping away.
No, it looks good right now, so keep going to the same person. Good to see you, Billy, Milken Institute. Thank you so much.